Welcome to the second edition of the Insider's Guide to Mortgages. My name is Mike Rennick. I'm the senior broker, the team lead with Team Rennick Real Estate Services, part of that great Keller Williams on the Water family. In this video series, the objective is to teach you about the inside, the outside of mortgages, the processes, how to best leverage one company against another. The expert that's going to share with us each and every week is Mr. Brody Wiseman. Welcome, Brody. Glad to have you back. Brody is the branch manager for Element Funding. Today, our topic is going to be the qualification process. What are the variables that go into that? Brody, what does it take?
Well, really it comes down to two things for clients, and that's what I want to discuss today, what those are, what they mean, and how they apply to the deal that you're going to get. So the first thing that I wanted to talk about was credit score. A lot of clients will come to me with excellent scores, and they think that the credit score is the only thing that we look at when qualifying. Many clients are under the impression that if they're at like an 800 or something amazing, that's just the end all be all. What credit score plays a role in for mortgages is pricing. And when I talk about pricing, I mean interest rate. So how much the actual loan is going to cost you, credit score is probably the biggest driver of that.
So the higher the score, there's less risk to the lending institution.
That's correct.
The less risk, the better rate that the client would get.
And vice versa.
Okay.
The lower the score, the higher the interest rate.
And the higher the risk for the bank.
Yes.
Okay.
So there are minimums for every product where the credit score needs to be. What I tell clients is if they're looking for a conventional mortgage, and what I mean by that is anything under $448,000, 620 is typically the minimum. Now you can qualify with something lower than that, but it's never a given. So I always tell clients, try to be around that 620 figure. And when you're talking about loans higher than that, so a jumbo price like out here on Longboat Key, you often see loans like that if people are getting a mortgage. 720 is a good barometer for that. And if you want the absolute best pricing possible, you want to be over an 800.
And down the road in one of the series, we can get deeper into how a credit score is calculated, what goes into it, how to maximize it, things like that.
Absolutely.
So the first variable is credit scores. The second variable, Brody,
is a formula that we use on every loan, every product, every loan officer, bank uses this formula, and it's called debt to income. So essentially what we do with that formula is we take your monthly debts. So that includes the proposed housing payment that we're looking at for the new home that you may be buying, and it includes all of your present obligations. So we're talking about credit cards, car leases, loans, things like that, including any present housing expenses that you have. So we add up all of those debts, and then we take your monthly income. So with monthly income, we're talking about gross income. So if I were to look at somebody's W-2, I would take their before taxed amount of income. If they're a self-employed borrower, we're gonna look at their net income reported on their 1040, add back things like depreciation. But essentially, as long as your monthly debts, including the proposed housing payment, are 43% or less than your monthly income, you're going to qualify for the property that you're looking at.
So at that point, the so-called experts have determined that that's just a good ratio, or it's the amount of debt so you can safely carry the new mortgage.
That is correct. So that is a guide for investors to make sure that the loans that they're making are solid, that there's a good chance of repayment on the loan, and that the client's going to be able to make those payments. So one thing about income is it's all about projection. So they want to be able to project your income for several years through the mortgage to make sure that it's stable, that they're not putting you in a risk of default, and to make sure that they're protecting you as a client and themselves as an investor.
So when someone applies for a mortgage through you work through this process and explain that. Talk to them about how if the ratios may be a little out of whack, how to legitimately get it taken care of.
That is correct. So we take a whole look at their entire financial picture as far as debts go. So one of the first things that we will do for a client is pull credit, find out exactly what their obligations are, take a look at their income, and it's a formula that if we get an application, we can pretty much tell you within a certain level of confidence that you're going to qualify or not qualify based on what we see. There are always exceptions. When you get into a self-employed situation, it can be a little bit more complicated. But for most borrowers that we deal with, it's something that we can look at in the first 10 minutes after receiving an application to see if it works.
So this is just the beginning of what I find to be a very complex process. That's why I work with experts, and I don't try to get too deep into this myself. We can best serve our clients by bringing in folks like Mr. Wiseman to help us through this. I want to thank you for watching this. Brody, thank you for being here. We'll be back again next week with the next episode of the Insider's Guide to Mortgages. Thank you for watching.